Hello. Good evening, everyone. Um, Thank you so much, all, for coming. I think it's a great time that you all are here. And what I'm going to do in the next 5 minutes is show you what is happening. But before we do that, can I very quickly confirm that you all can hear me clearly and you can see my screen with investing.com website? Okay, great. So on this screen, what this basically shows is the economic calendar for the day. Now, for those of you who don't know what an economic calendar is, it kind of lays out all the piece of fundamental data releases about the state of the economy. It's the figure sheet or the economic calendar is scheduled every day, and as we can see, in about 5 minutes from now, um, just 1 second. Yeah, in about 3 minutes from now, we have, so here, in about 3 minutes from now, we have three pieces of information from the United States that's going to be released. The first piece of information is the core CPI, core PPI, which is the purchasing price index. It's a measure of inflation. The second one is the initial jobless claim. So it kind of states how many people, how many unemployed people have gone to the US agencies to claim benefits because of the fact that they are unemployed. And the third and the most important piece of data you can see here by three bull signs. This states that this is a very important piece of data. Purchasing price index is PPI. It's a monthly data released every month around mid-month. And if we very quickly see the trend of this data, if we very quickly see the trend of this data, we can see that the data has been fairly positive. So what this technically tells you is if there is a basket of good which is worth $100 in the previous month, what is the value of that basket of goods in this month, right? So very quickly going back, if we see that the markets are expecting the forecast, right? The forecast is 0.4%, which means that they're expecting a 0.4% increase in the price of the goods compared to the previous month. And all of this information, so the data is going to be released in about 2 minutes, as we can see. And now going back to my trading platform, if you can see my screen very quickly, I'll introduce you to what I have. This price ladder here is the price of your E-mini S&P contract, your S&P 500. Out here, I have your Dow Jones, which is your Dow Jones 30 index traded in the US. Down here, I have your US 2-year Treasury note, right? This is the price of the bonds issued by the US government, which has a maturity of 2 years. This is the price of US bond for 5 years. And out here, we have price of the US bond for 10 years, right? Very quickly on this chart here, as you can see, this is the 10-year chart, the 10-year US Treasury notes chart. And as soon as the data will be released, depending on whether the data is in line with the expectation at 0.4% or better than, I would say, expectation, the prices will move. So I think the clock's ticking. We are about less than 60 seconds to go, right? And very quickly, the center here is the price of the instrument. On the left, out here, we have all the people who are bidding to buy. So just to explain you, there is 879 contracts waiting on 125.10.5 to buy this bond. And there is 742 or 715 contracts, right? Yeah, waiting to be sold. So as you can see, the markets are starting to move now. They are trying to anticipate what the data is going to be released. And it's going to be very interesting. If the data is good, then you will see a sell-off in the bonds. If the data is worse than expected, then there will be a buying in the bonds. That's what at least the theoretical part says, right? It's still 5:59. I think in about a few seconds, three pieces of US information will be released. So let's see what is the data that it's 6 p.m., right? Not much has moved, which will mean that, okay, so the bonds are now starting to see a sell-off. As you can see, the price is starting to tick down on this chart, right? Same is the case with all the bonds here. So these are the bonds, these three ladders. This is a 2-year bond seeing a moderate sell-off, a 5-year bond sticking slightly lower, and 10-year bonds is starting to go down. Now, since the bonds are seeing a sell-off, I would like to think that the data is broadly in line with the expectations or slightly better. And let's very quickly see to confirm what the data is. So yeah, as you can see, this piece of information wasn't updated when we started this webinar, and now it's at 0.4. So what this tells you is there is no surprise element in the market, right? Markets were expecting the purchasing price index to be at 0.4%. The data that came out is 0.4%, so no surprise element. But usually what happens is a lot of the times, the actual data that is released kind of beats the estimate either on the upside or the downside, and the markets then start to price in the extra surprise element. So with that, unfortunately, not a lot of movement in the market, but it is not always the case. Again, I think as traders, our job is to really be ready whenever there is an important piece of data to be released, so you can you can take benefits of the opportunity and make some P&L along the way. So great. I think unfortunately not a lot of movement, but let's get started with understanding a bit more in detail about what we have on the screen, what are the kind of trading strategies. I think that's the broader agenda for the day, right? Before we get started on this one, I would quickly like to understand if you all had a chance to download and install CQG and create a username and a password. So my colleague Kezia is going to throw out a small poll in about 2 seconds from now. And if you can all please give your feedback, I think it'll be very, very helpful to me. Both, you can just take one. Okay, so I think with the first one, unfortunately, it appears like not many people have had a chance to download and install, but I think that's okay. For the ones who have managed to, managed to get this application installed, if you would like to log in and probably trade with me for the next 45 minutes, you already should have your username and password. If you log into your CQG, you should see a screen. My workspace is a bit set up, right? But I think I'm going to show you in terms of how to create a workspace as well. And then we will look at very quickly some theoretical aspects of trading strategies and jump straight into the execution part of it, right? So I think one of the things that you will have to do today is to really shuffle between the two applications. One is where you will see my screen, and the second one, when you're trading on your own screen, you'll have to go back to your CQG, okay? So if you have your CQG, you should probably have something on it already, right? If not, you will probably have a blank screen like I have here. Just going to bring up a blank screen. So that's my blank screen now. And I think this is your CQG. There is 2 pieces of information, or in fact 3 pieces of information that you will need as a trader to really view the market and make trading decisions and monitor your P&L and risk, right? So the first one really is your DOM Trader, and you can install DOM Traders from clicking on the More and clicking on DOM Trader, right? You will see something along these lines. It's a Windows-based application, which means you can customize the size to your own needs. Once you have created one DOM Trader, you will see the code of the product up here. which is EPZ7. Now, EP is your code for E-mini S&P 500. Z7 stands for the contract which is expiring in December 2017. So Z is technically your December, 7 stands for 2017, which is the active contract. The center column here, 2549.25, this is the price of S&P 500. And onto your left, what you see is 837 quantities or 837 futures lot waiting to be bought on 49. Right. Similarly, 430 quantity waiting to be sold on 49.25. The participants can place orders or pull orders, and these quantities will change accordingly. Right. If you, as a market participant, wanted to, let's say, initiate a long trade at 2548.25, all you'd have to do is take your mouse pointer, click on the bid quantity, and there you see. Right. You see one on this left side here. This is my one lot order placed in the market to go long, right? If I right click on that order, it gets pulled away from the market. So I'm no longer bidding. I've pulled my order. One more time I click, I've placed my order, right click, I pull my order, right? On the price ladders out here, if you just click on this CQG QTrader icon, normal click, you will see an option to replicate, which means you will create one more price ladder. And if this is an active window, you can start typing a code for a second instrument, right? So we are already looking at E-mini S&P 500. I'm going to write YM, which is the code for your, excuse me, this is your code for your Dow Jones 30, right? So for those of you who are aware, Dow Jones trades at about 22,800 these days, right? The markets are currently bids at 22,796, offered at 22,797, 16 lots offered and 7 lots bid. Now, as you can see, there is a huge difference between these two instruments in itself, right? S&P 500 has got bids and the offers in the quantities of hundreds and multiples, right? So there's 300, 700, 800 on the offers, pretty much about the same on the bids. It kind of states that, people trade this instrument a bit more than the Dow Jones 30. On Dow Jones 30, you can see there is bids and offers in the order of, double digits. So low double digits like 12, 15, 30. There's one at 150, probably a fund trying to, sell. And this is very interesting. I think the price is 22,800, which is also a psychological number, right? So that is why someone is trying to initiate a short position or probably, trying to offload their long positions. We don't know. I think all we know is, this is the state of the market currently, and people can buy and sell depending on whatever their views are. So before we move further, I think I'm going to go back to the presentation to give you all a quick overview on, some concepts. So when we are trading on the markets, it's slightly more easier to understand. Right? Can I very quickly ask a question? If everything that I'm talking makes sense to you, do you want me to go slow or is the pace fine? If you can very quickly, please give your feedback on the chat. I think that'll be helpful. Okay, all right, great. So what are the products that we are going to be covering today? Very quickly, we are going to be looking at the US bonds that we saw at about 5:55 up to 6 o'clock. We're going to look at the 2-year Treasury note, the 5-year Treasury note, 10-year Treasury note, 30-year note. Actually, it should be 30-year bond. It's my mistake. It's a note here. On the CQG platform, each of these instruments have a code. A 2-year note has a code of TUA. The 5-year note has a code of FVA. The 10-year note has a code of TYA. 30-year has a USA, and so on and so forth. So each product has its unique code on CQG. If you go to a different platform, the platform will have its own code for the product, right? So we're going to be looking at some trading strategies on the US bonds. We're going to be looking at the US equity indices, E-mini S&P 500 and E-mini Dow Jones. We are going to be very briefly also going to look at the UK equity index, which is the FTSE 100. It's the I would say top 100 companies in the UK that come together to form an index, and it's traded. And then we are going to look at an short-term interest rate instruments from the Eurozone, right, which are called as 3-month Euribor futures. The code for which is QEA. Very quickly going to the last column, each of these products on one price movement result in a profit or a loss, and the dollar value of each of those instruments is stated here. So if you bought one lot of 2-year T-note, and if you sold it immediately on the next price, you will make a profit of $15.625. Similarly, if you bought 5-year note at price 1 and sold it at price 2, you will make a profit of $7.8125. 10-year note is 15.625. We call this as a tick value, right? The minimum price fluctuation. And the 30-year note has a tick value of $31.25. E-mini S&P 500 is at $12.50. Dow Jones is 1 full point trading at $5. The UK benchmark index FTSE 100 trades at a £5 tick, right? So if you bought price 1 and you sold the price 2, you will make a profit of £5. And the 3-month Euribor futures, the interest rate contracts, trade with a tick value of 12.50 euros, right? So as you can see, if the product is listed in US, it will mostly have the tick value in US dollars. If it's listed in UK, it will have a tick value in GBP, which is sterling. And if it's listed in Eurozone, it will have the tick value mostly in the euro currency, right? So going to the next slide, very quickly, let's get an overview on. Okay, so I think we have a question in terms of what is a tick value. I think I explained it earlier, but I'm going to repeat it one more time. Let's get back to the trading screen. As you can see, if let's say I bought, I'm going to go on my previous workspace. Just 1 second, guys, bear with me. Okay. So a tick value is, as you can see, S&P 500 currently trades 25.48 and the next price is 25.48.25. If I went long at 25.48 and if I sold the same contract for a profit at 48.25, the dollar value of profit or the loss that I will make is the tick value, right? So the dollar value associated with one price movement is what we call as a tick value. And the tick value for each of the contracts that we are looking at is different, right? So S&P 500 one more time is $12.5. Dow Jones is $5. If I bought 793, sold 794. As you can see on the screen here, it will result in a $5 P&L, right? So if you are on the right side, you will make $5. If you're on the wrong side, you will lose $5. The 10-year treasury note, if you bought 8.5, so 125 is constant. The way I'm going to say it is 8.5 is the price. If I bought 8.5, I sold 9, right? it will result in a P&L of $31.25 US. So let's very quickly place a demo trade and see what the P&L looks like. So this is my account. As we start now, the account balance is $100,000 US, and I have no trades today. Very quickly, to give you an overview, this is my working orders. So if I am working in orders, if I'm working orders in the market to either buy or sell something, they will all appear in this working tab, right? So very quickly, I want to buy S&P 500 at 47.50. As you can see, it shows on this ladder. I want to sell it at 49. It shows here, right? So these orders are currently active in the market, right? Because I decided to buy them or sell them. Now, if I no longer want to buy or sell them, I can just right click them and it'll get pulled, or I can click on this cross button here and the order gets pulled, right? It's asking me, are you sure you want to cancel the order? And I say yes. So let's place the first trade to confirm the tick value are correct. I'm very quickly going to place a limit order to sell here and a buy here. And let's see which way the market moves. Right, so hopefully this is slightly more clear. You can see I have a one lot limit order to be sold at 48.50. I have a one lot. So I just got long, right? I bought 48.25 and the markets are now at 450 offers, right? So if the price continues to go down, I will have a loss. And if the price moves back up to 48.50, I will make a profit. Let's watch and see what happens. Again, this trading decision that I just made is without any kind of a logic. So please don't blame me if we incur a loss. For those of you who've managed to install CQG on their PCs, please absolutely feel free to click around and test your platform and come back to the webinar screen once in a while to see how we're doing things. So the price, which was earlier, about a couple of hundred bids, I placed my limit order to buy and I got bought, and the market all of a sudden flipped to sell it. The gray box here that you see kind of tells you how many lots are trading in real time, right? So there's someone who sold one lot at 48. And if we can see very quickly on the P&L panel, sorry about that. If you can very quickly see on the P&L panel, it says OTE, which is Open Trade Equity, right? Open Trade Equity is your running P&L for all the trades that are open in the market. So if the last traded price is 25.48, it will say I'm losing 12.50. I still haven't closed my trade, right? It's still open, and I'm hoping to sell this at 48.50. Good for me. The markets have gone 48.25 bid, which means the price that I have bought now has 225 contracts waiting to be bought at the price, and hopefully I should be able to sell 48.50 to make a $12.50 of profit. Again, please bear in mind, I just bought this because I wanted to show you there is no logic in this trade, absolutely no logic at all. It's moving a bit slow. I think it's not moving fast. That's the usual property of S&P 500. It doesn't really move fast as much. It'll trade slow. It'll take its own time to trade. Very quickly, let's look at the charts of S&P 500 to see if we are on the right side of the trade. So on the chart window, you will see a cursor here that blinks. It allows you to enter your code for the product, which for S&P 500 is EP. So I'm going to enter EP, and it by default picks up the Z7, which is the first and the active contract, right? I am looking at a 30-minute chart, so each of these bars here represents the activity of this contract over a course of 30 minutes, right? So the current bar, which is this bar, it started at 6 o'clock India time, and this is the active bar now. We are 18 minutes past 6 o'clock. At 6:30, this bar will finish based on the price, and then the next bar will start, right? So it's still not moving much, still pretty much there. And as you can see, the markets are ticking down a little bit, but not really going anywhere. I'm going to change this time frame to 5. So I'm currently on an E-mini S&P 500 30 minutes. If I enter 5 and press enter, the chart gets changed into a 5 minute. So each of these bars now represent a 5-minute movement, right? So in the current 5 minutes, this contract has traded a high of 48.50, as you can see here, and it has traded a low of 48, which means it has technically only traded 3 prices in the course of last 4 minutes, right? So still not getting filled on 48.50. Markets are extremely slow. which can happen from time to time. They will not move in your favor when you have a position, but when you don't, and when you're just taking paper trades, they will tend to give you a lot of profits or losses. Now, the other thing that you all must also keep in mind is that the quantities that we see flickering on the bids, which is this panel here, and the ask, which is this panel here, are not always human beings that are placing orders or pulling orders, right? So this is the global offers from all market participants in the world who are currently offering 450 lots to sell at 48.50. I have one lot with them, right? This is a simulated market, so this is not real money. But if you had real money and if you placed one here, assuming no one else places the extra orders or pull extra orders, the 753 here will change to 754, right? So when you place your orders, the global, I would say, trading community will be able to see that there is an extra one lot order that has come to be sold at 48.75. So very slow, it's getting on my nerves. I feel like scratching it. Scratching is technically a term that you sell it at the same price that you bought it. And a lot of times traders also take that kind of a decision because the markets are not moving in their favor or they're not moving against them. And it's probably the best decision that they think they should be taking at the point in time. But not moving much. I think we will leave it, here I'm going to continue working at 48.50 and hopefully I should get filled in about next few minutes. So this is still a 5-minute bar here, as we can see. This bar, the red bar that I'm currently hovering my mouse at, is the high and the low for the last 5 minutes, and it closed. So the way to read the bars is, each bar has 4 pieces of price information in it. It captures the open price, the high price, the low price, and the close price. So if the bar is green in color, it technically tells you that the markets closed higher than where they opened during that time frame. Okay, great. So I think I sold 48.50 and the markets have also gone bid now, right? So I made a profit of 1 tick. And if I go back to my P&L summary, you can all see I made a profit of 12.50. So it kind of explains you that's the tick value. If I held on to my position of 48.25 and I sold it at 48.75, I would have made a P&L of $25, right? So thank you so much for whoever asked that question. I think that gave me my first profitable trade for the day. So moving on. Moving on very quickly, looking at the kind of trading strategies that we are going to experience or that we are going to learn in the course of next 30 odd minutes. I don't think we'll have a lot of time to go through all of them, but a simple trading strategy. So it's pretty much what you and I, or you and I and all the other retail market participants will be doing, right? Just buy or sell. So that's only one style. Something very similar to what we did with S&P 500 before a few minutes. We bought 48.25. Sold 48.50, realized a profit of 1 tick. The second one, and simple trading strategies are mostly traded on the concepts of supports or resistances. So I think we will leave the concept of support and resistance for some other session and quickly move on to the other strategy types that are used by professional traders and financial institutions. So this is just a very high level summary, right? The second value is the relative value trading strategy. Now, the way relative value trading strategy is different from a simple trading strategy is, in a simple trading strategy, you would take a view on the direction of the market, right? So when I bought 48.25, I was hoping that the markets would rally upwards for me to realize a profit, which means I'm taking a long view on that product, right? In a relative values trading strategy, on the other side, you don't really take a view on one single instrument, but what you do is you take a view on the price relationship between the two instruments, right? So if we have to very quickly look at the example, I'm going to open up an Excel to show you very quickly one of the concepts. Now, we all know that US has two major benchmark equity index. One is your S&P 500 that we just traded, and the other one is Dow Jones. They're technically different. S&P 500 is 500 companies. In the US, Dow Jones is 30 companies. But if you look at the charts historically, they are very heavily correlated, right? So if we can very quickly just get an understanding of that. Opening up a website, tradingview.com. And I'm going to launch a ticker EP. Or SPX. SPX is your S&P 500. And I'm going to look at the interactive chart. So as we can all see, this is the S&P 500 cash price that we are looking at, 2,555. We were trading 25.48. There is a price difference between because the one that we traded was the real-time price, and the one that we are seeing on this web browser is delayed by about 15-20 minutes, right? So therefore, there is a price difference. Plus, the contract that we were trading is a futures contract, and this is probably the cash market price, right? But the objective of me to get you here was to give you a quick overview of how Dow Jones So DJI is your Dow Jones Industrial Average, and I have added one more chart on the top of the other one just to very quickly give you guys an overview. So if you can see now that there is a very high degree of correlation between these two instruments, right? Your first colorful bars is your S&P 500, and your second orange line is your Dow Jones index. So as a trader, when you're trading a relative value trading strategy, you are not trying to take a bet on where each of these is going to trade in the course of next 5 minutes, 30 minutes, an hour, a day, a week, a month, right? But instead, what you do is you take the dollar value differential between these two instruments and then take a judgment on which one is overpriced and which one is underpriced, right? So for you to be able to do that successfully, the trick that is used by, I would say, professional traders is, I would say this is my S&P 500, this is my Dow Jones, right? So S&P 500 currently is trading at about 25.48 on the futures, and the Dow Jones is trading at 22,794. Now, as we saw from the tick value, S&P 500 tick value is 12.50, but the full point value, the price from 25.48 to 25.49, which is one full point, is worth 4 times 12.50, right? Because it trades in quarter tick. So quarter tick is 1/4 of a price, which is 48.25 is the first price, 48.50 is the next price. So the full point value is $50, right? If you bought 48, sold 49, it's a $50 P&L. Similarly, on Dow Jones, the price move, the one full point value is still $5, which is also the tick value, right? So when you buy one, or when you are actually looking at the contract value, you take the multiplier and say, it's worth $127,400 if you bought one S&P at 25.48. That's the portfolio value that you are long at. And similarly, if you trade Dow Jones, you create a notional long or a short value of $113,000, $113,970, right? Now, I don't know, how the relationship between these two have been in the past, but if I was to not have a view on the market, I will need to equate my long and short position across these two instruments to neutralize, one with the other. Now, since one is a bit higher than the other, I'm just going to take a very quick ratio to see how much is one higher than the other, and it tells me it's 1.11 times, right? So technically, if I trade that, so what it actually also tells you is, if you trade that with 10 contracts and if you trade that with 11 contracts, right, then you will be very close. You'll be a very close dollar value hedge, right? So currently the dollar value differential between the two, if we can see, is $13,430. But when you equate those with these ratios, you will see that the dollar value differential is much lower, right? So the price is 28, 25, 48. Each point is $50, and we are trading it with 10 contracts, right? So now the underlying becomes 1,027,274,000. And similarly, if you look at the other one, you will see that it's 1,025,000. And now this is 223.30. Now, in absolute terms, this number is higher than 13,430, but you must also consider that this is on a size of 10:11. So technically, if I divide this by 10, which is the minimum value, contract lot size, then I will see I only have a dollar exposure of $2,033, right? So it's more better hedged. Now, as a trader, depending on where you are trading, if you're trading with a prop firm, they may not really let you trade that big size. So you might just trade 1:1. If you're trading for a fund or a bank, or I would say a bigger financial institutions, they might actually let you trade the bigger size, right? So once I know that I have to trade these two in 1:1 contract, I'm very quickly going to go back to my charts and see how that relationship looks, right? So that I can identify which one is overvalued or which one is undervalued. So I'm going to use a very simple mathematical operator, just like I used on the spreadsheet to create the chart. So EP, which is my S&P 500, into one lot that I'm going to trade, which is equal to $50, minus YM, which is the code for your Dow Jones, into 5, which is the tick value, into one lot, right? So in this strategy, S&P 500 is my first leg, Dow Jones is my second leg, and I'm taking the dollar value differential for one lot between the two instruments, right? So when I hit enter, I will see the kind of chart that I see now. And now what this tells me is that the difference between one lot of S&P 500 and one lot of Dow Jones, as we saw, the dollar value difference was $13,400 something, which is also here, right? Now, if I change this to a smaller time frame chart, let's say 1 minute, then I can see this kind of creates a noise as it moves, right? So both of them are moving in one direction, but usually one will lead and the other one will lag, right? And that's what basically creates the I would say noise pattern. But they also move fundamentally different over the course of long time frames, right? So I wouldn't really recommend you to take a longer duration trades when you're trading relative value. It's different when you trade more correlated instruments, but this is equity, right? So as you can see that the differential between these two, when it was 425, it kind of moved back to 475 at about 6 o'clock. And then again from 425, it moved to 450, right? So as a relative value trader, I think what traders do is they identify the range. If you're trying to trade the range, they identify the recent range in which this pair is trading, and then initiate trades as the market price, which is 13453 as we speak, approaches one of these two levels. Right, so I think we will keep this on watch. If the price differential comes to 13,425, I'm going to buy S&P 500 and I'm going to sell Dow Jones, right? And then wait for this, I would say, spread difference, which is the difference between the two, to revert back to a higher range, which will enable me to make a profit. Now, when you're trading, I would say, relative value trading strategies, you don't really care which leg of the trade you make money on, because there is in most likely scenario you will make, let's say, if your overall P&L was $50, it is possible that on one of the legs you will make $250, and on the other leg you would have been losing $200, right? But it doesn't matter to you, because what you're doing is you're trading the difference between the two, and your total P&L is technically the sum of the P&L on both the legs, right? So this is one of the ways in which I would say traders look at the market when they don't want to take a view on where that instrument is going to trade, right? I don't need to know if S&P or Dow Jones is either bullish or bearish, because what I know, or what my underlying assumption is, that over the course of long term they are both highly correlated, and broadly they will both move in the same direction. And when they do move in the same direction, they are not both going to move exactly at the same time, right? One's always going to lead, the other one's always going to lag. And I'm trying to capture the price differential between the two instruments without necessarily having a view on the market, right? So that's one, I would say, relative value. The same concepts of relative value can also be applied to bonds that we have here on the screen. But on the bonds, the concept is slightly different, because bonds are fixed income instruments and they have the coupon payments or the interests associated with it. So to give you an example, if you invested in a 5-year bond, there is more likely a chance that you will get interest every 6 months. And when you are trying to value a price of a bond, then you must also take those coupon payments or interest payments into account. So I think moving back to the next set of strategy, unfortunately, I think there is not a trade that we can take now. But if you still want to take a trade, I think we can do it. And I'm going to actually initiate a trade at 13,445 as a long trade, because I'm guessing that the markets will move back up, right? So the markets are now approaching 13,433, which means that if I buy S&P and if I sell Dow Jones, then I will create a long position on this spread, which is the two-legged spread. And a lot of the times you may not actually get the price that you see on the chart here, because it may require you to buy a bid price and sell a ask price, and they may not really happen instantaneously. So you might end up taking a leg risk. Now, a leg risk, for those of you who don't know, that is technically when you're trading relationship between two instruments, and for you to do that, you have to buy one and sell the other, where both of them move in the same direction. It is possible that you're trying to buy 48.25 on S&P 500 and you're trying to sell 797, and if the market rallied downwards, then you might end up getting a long position 48.25, but you may not necessarily sell 797, right? So you will not actually end up buying the spread at the price that you see, but you just have one long position, which is equivalent to having a directional view on the market. So when you're trading spreads, or when you're taking positions on two instruments simultaneously, it's extremely important that you don't end up with a position on just one leg, because that's not the objective of the trade, right? You're trying to trade the relative value difference between the two. So you must create a position on both at the same time. So trying to trade the spread, working an offer on 797, as you can see, one lot limit order. And I'm also working on one lot bid on 48.25, right? The markets are currently at 797 on Dow Jones, 48.25 on the S&P. So this is a slow trade. I think it's not extremely exciting as a trader when you're trading strategies like these, because again, I think, as I said, on Tuesday, trading as a profession, I think it's misunderstood, because a lot of people want to get rich very quickly, and that's not the case. It's about taking a lot of small trades throughout the day with absolutely, I would say, tight discipline and risk management. such that one single losing trade does not kind of take away the P&L for a lot of the good trades that you made earlier in the day, right? I might not get this trade. It's okay. I think I'll take the trade when the market offers me another opportunity. So I think for now I still continue to work my positions, but nothing seems to happen. Now it's possible that I might end up buying 420, 48.25, and this price is already starting to move down on Dow Jones, right? So as a trader, I think what I will do is if I end up buying 48.25, I will sell whatever price I can on the Dow Jones to still have my overall position in the spread and not have a leg risk on my trade. Right, so not moving much, slow. What will be very exciting is that in about 20 minutes from now, the US cash equity markets will open, and you will see, I think, let's come back to this chart in about 20 minutes by the time we are also finishing the presentation. Let's come back to this chart and see how volatile these instruments get when the cash markets open. So in about 20 minutes, it's going to be equivalent of 9:15 IST. When your NSE and the BSE markets open. So I think the cash markets in the US will open very shortly. And this will then be more, I would say, interesting to trade. Now, remember one thing, as we can see on this chart, when the US cash equity markets open, you will see that the noise that is created between these two will no longer be the same, because the markets are going to move fundamentally for the course of first 5 to 7 to 10 minutes, and you will see a strong spike here, right? And I think if I have to show you a spike, whenever the cash markets open, you see that they are usually trading, I think it's the wrong chart. So they're usually trading in a range, but when the cash markets open, you will see that there's a huge one-way movement, which means one leads and the other one's not able to catch up, right? So as an intraday trader, I think one of the other techniques is to really be aware as to when the noise relationship will not exist and when it will move in one direction, so that you don't end up being on the wrong side of the trade, right? Because all you're trying to do is really make very small profits, but if you are stuck on the wrong side, you might end up losing a lot more than what you can potentially make in 4, 5, 6, 7 trades, right? So that's dollar value, relative dollar value trades. As I said, talking about the fixed income instruments, the trade, these are based on the concepts of duration neutrality, and the duration neutral concepts is technically trying to match the cash flow of a short-term bond and a long-term bond, right? So a 2-year bond will, if it pays interest every 6 months, right, you will have 4 coupons, whereas a 10-year bond will have 20 coupons, right, because it pays interest twice in a year. So there is a mathematical formula to equate those two cash flows and then arrive at the right kind of a ratio to trade one versus the other, right? It's simply not the way that we did on the Dow Jones and the S&P. So if I have to show you very quickly how that is done, I think it's a detailed concept, but let's assume for now that we understand and the ratio between a 2-year treasury bond and a 5-year treasury bond is 5 lots versus 4 lots. So you trade 2-year notes with 5 quantity, you trade the 5-year note with 4 quantity, and that kind of matches the cash flow between those two legs. When you plot that, you will see a relationship like you see here, and this is a more consistent or a range-bound chart on the course of 5 minutes, right? And the way I did this is, as you can see on this formula here on the top bar, TUA is the code for your 2-year bond, which is the first leg of my trade. Z7 is the December 17 maturity. This is multiplied by 10 because the underlying of this bond is twice, or the underlying of this bond is actually $2,000, right? And I'm going to trade this with 5 lots. So 5 multiplied by 2 gives me 10, and then there's another 1,000 minus the 5-year bond. I'm trading with 4 lots. Which has underlying of $1,000 each. So I'm saying 5-year multiplied by 4,000, and I'm taking the difference between the two, trading at an interval of 5 minutes, right? So when you do that, you will see that the relationship between these two kind of has been trading in the range of 608,015 to 608,296, right? So what this technically means is that the price differential between the two has a dollar value movement of close to $270, right? And sorry, $280. And the way I did this is just took the difference between the two lines that I've created here, right? So currently the portfolio value of a 2-year and a 5-year is at $156, the last 3 digits. And as a trader, again, I think the objective is to really read the chart that we have in front of us, try and see what it has been doing, and then identify the spots from which it is exhibiting a certain kind of a behavior. So if I have to explain you that in a bit more detail, I am looking at this this zone here, the first line and the second line, right? From yesterday, so yesterday the price moved from 400 till about 015. It went back up, right? It came back to the same zone again. It kind of ticked up, and even today it's coming to the same price and then seeing a bit of a bounce off, right? So as a trader, I think what if I have to wait for an opportunity, I'll wait for this price relationship to trade in the range of 046 to 015. And when that happens, I'm going to initiate a 5-lot long position on the 2-year treasury note, which is this instrument here, right? And simultaneously, I'm also going to create a short position of 4 lots on this US 5-year treasury note, right? Once I've established both those positions, I will then wait for the market to. So my assumption is that when the price is at 015 as a differential, it will come back to its, I would say, median range. And once I've taken the trade, I'll wait for that price to come back in the range, and then take my profit based on my profit objective. Please remember that it can also happen that once you've initiated a long position at 015, the relationship can continue to distort further, and it can it can move further lower, in which case I think the idea really is to have a very strict and a tight stop loss in place. It's a price point that you will need to decide before you enter into a trade that that you will get out at, right? So after you've initiated a trade, you must have 2 broader objectives. The first one is your take profit levels, and the second one is your stop loss levels, right? Again, there is no trade here, but let's wait for next 10-15 minutes to see if we can get a trade. So that's on the bonds side of stuff. Again, it's a relative value strategy, but more precisely known as the duration neutral strategies, right? It may be getting a bit more technical for maybe some of you, but I think that's I would say that's the only language in which it can be talked about. There's unfortunately not much simpler terms that can be used. So going back, I think the most interesting one that I personally like is the execution strategy, and it's pretty simple. But what you do in this strategy is you are just watching the market price action and then deciding on, I would say, smaller inefficiencies, right? So for us to look at the execution strategies, I'm going to use the 3-month Euribors or the Eurozone interest rates as an example. Now, for those of you who would like to understand what this price means, so the first contract I'm looking at is a QEA Z8, right? And a Z8 stands for December 2018. A price of 100. So this market is currently bid 215. 100 is constant, so I'm going to say 215 is the bid price with 2778 lots. And 220 is the ask price with close to 80,000 contracts, right? So as you can see, there is a striking amount of difference between all the instruments that we've used as an example. S&P 500 had about 500 to 1,000 quantities of bid and ask. Dow Jones has about 20, 30, 40, 50. Your treasury bonds, as we can see here, has sizes that are different. 28,000, 30,000 on the 2-year note, about 2.5, 3,000 ish on the 5-year note, and on the 10-year bonds, it's again pretty decent size. 2, 3, 4, 5,000 worth of quantities, waiting to be bought or sold on each price. But at the same time, when you look at the instruments in the Eurozone on the short end of the curve, you will see that the contracts have, again, I think 5, 7, 10,000 lots standing on each price, right? So going back, Z8 stands for December 2018. It's a 3-month forward rate, right? So what this technically means is that if I had to borrow money or lend money starting December 2018 in the Eurozone, what is the interest that I will pay or I will receive, right? And the way to calculate interest is actually 100 minus the interest rate gives you the price. Now, since this price is trading above 100, it signifies that if you were to deposit your funds with the central bank, they will charge you an interest on it, right? Which is the case with Eurozone as we speak, because the Euro economy hasn't been performing extremely well for the course of last, I would say, 5 to 6 years when since the time of European crisis. And so to kind of boost the spend in the economy, the central banks have lowered the rate to 0, right? So at end of every, I would say, business day, all the banks with surplus cash, they kind of deposit it with the central banks, and central bank in India at least pays interest on those deposits. But in the Eurozone, it's the other way around. If I had 100 euros extra as a bank, it's in my own benefit to actually lend it out to a customer than to actually deposit with the European Central Bank. Now, this equation changes as you go out further. You look at the December 2019 contract, which is trading at 99.95. So it says there is an interest rate of 5 basis point for a 3-month period, right? So if you had to lend money or borrow money for 3 months from December 2019, then you will get charged an interest based on the current market price of 0.5%. Similarly, if you look at the same 3-month lending or borrowing rate in the Eurozone from Z0, which is your 2020, the year 2020, the market price is 99.65, which kind of signifies that the interest rate is 0.35%, right? So these are priced differently than your equities and bonds because they are short-end, I would say short-term interest rates, right? Now, having understood that what these price means, as a trader, the idea for you to really is make profit, and these contracts are listed on ICE. I think as we saw the other day, ICE is a US-based exchange, the youngest exchange. And there is also a spread contract, which is Z8 minus Z9 kind of combinations already listed on the exchanges itself. So this instrument that we see here, it says 26 bid, 26 and a half offered, right? It is the price difference between these two instruments itself, the Z8 and the Z9 contract, right? So as a trader, if I was able to buy 21 and a half on the first price and I was able to sell 95 and a half on the second price, I would technically create a long position on 26, which is the difference between the first two legs, right? So being long on Z8, being short on Z9, it gives me a spread position contract on these two legs. And I end up being long at 26, where the market currently has 35,000 contracts waiting to be bought, right? So I can place an order here, I can place an order here. There's a high chance that I'll get filled on one leg, the other one I may not, right? But as a trader, when the markets are a bit volatile, you can end up getting fills on both the legs. And when you do that, the price that you create on the same instrument is in your favor, right? Because technically, if you wanted to buy 26 and if you placed your order here, you probably have to wait for a very long time to create a long position on 26, but you can create those kind of positions using the single legs, right? So if I got filled on both of those legs, I'll be long 26. I can work my orders here, 26 and a half. It'll give me a one tick of profit, one lot on Euribor, which is equal to 12.5 euros, right? Unfortunately, the markets are very slow. So even if I were to place my orders, I'd like to think that we may not necessarily get filled. Similarly, I think looking at the next contract, the difference between Z9 and Z0, as we can see, the first price is 99.95, the second price is 99.65. So technically about 30 is the price difference. And the markets on this, which is the difference between Z9 and Z0, is 30 bid, right? So if I wanted to create a long position on 30, without trading this price ladder itself, I can synthetically create that position by going long on 95 and going short on 65, right? Which technically gets me long at 30, and then I can work my orders on 30.5, gives me a one tick profit. Happy days. So I would say those are the broader kind of strategies. In about 4 minutes, the US cash equities market will open. So we will see how the spread difference between the Dow Jones and the S&P will move. But in the meanwhile, if there are any quick questions, I'll be very happy to take them and maybe try and answer them. So if there are any questions, please share those on chat. Okay. Right. So where the interest rates being speculated as to how they would be in the coming year. Okay. So I think if I understand this question, the current interest rates in the Eurozone are at 0%, right? So technically central banks will not pay any interest to the commercial banks if they were to deposit any surplus cash with them. But the expiries that we are looking at are in the year of 2019 and 20. So what the markets are saying is that the state of the European economy currently is not extremely great, but then they hope that the economy will get better and the central banks will be able to raise the rates then, right? So basis on that expectation is where the markets are currently pricing a positive interest rate of 0.35 or 0.55 on the 19 and the 20 year, right? So these are the future expectations basis the information that is available today. These are not the confirmed rates, right? So hopefully that kind of answers your question. The next question that we have is there any session for NSE or BSE? Unfortunately, we don't have those sessions in this webinar, but then those I would say concepts are covered when during the course that we are going to launch in a very short time. So we're going to look at all the kind of possible strategies that can be deployed on the instruments that trade on NSE and BSE both, right? So the concepts of relative value are definitely applicable on both those exchanges, both on cash segment as well as futures segment, and the concepts of Greeks are applicable on the options that are available on the equity index or the I would say stock futures. So again, I think given that we had a very limited time to give you guys an overview of the kind of trading strategies. We chose to give you an overview on the global markets because Indian markets are very limited in terms of the kind of scope that they offer, if you ask me, right? Next question. Hopefully, I think that kind of answers your question. So yes, the strategies on Indian markets are covered, but that's in the course, not covered, unfortunately, in the webinar. To learn such technical, which course is available? The course that we are currently offering, the MCX, Global Markets Pro degree, focuses on all the aspects in detail that I currently gave you an overview of, right? So I think that kind of answers your question. And also, if I can tell you, my opinion very honestly, this is the first of its kind of course in India, and absolutely there is no other institute that does this kind of a training program, which is extremely comprehensive in its own aspect. The next question that we have is, can we have this platform for the use of forex trade? Absolutely. I think if I can. So I'm going to show you one of the forex instruments that's available on CME to trade, and the code for that is EU6, which is your Euro USD. So as you can see on the screen here, this is the price of Euro USD on the central order book, right? So there are a lot of, I would say, what I call scam platforms or scam brokers that offer you access on MT4s and MT5s, and trust me, guys. The deposit that you make with those brokers are absolutely unsafe, because every time there is a small move, or every time there is a reasonably decent move in the markets, one of these brokers are going bust. So my personal recommendation is, if you want to trade forex, please trade or open an account with a broker that has a very strong credibility, and not just use the ones that can actually wipe up your capital for a very little profit that you may actually make. Can you help us with trading techniques in Indian stock market? Absolutely. I think, again, as I said, given the limitation of time that we had for this webinar, we could only cover very, I would say, little things. But the trading strategies on the Indian stock market is covered very, pretty much in detail on the course that we are coming out with, which I think information of which will be available with our counseling team. So please feel free to get in touch with us for any questions in that regard, and we'll be able to come back to you. Can we get more seminars like this in futures also? Absolutely. I think I'm very pleased with that question. The idea is to really spread awareness about the kind of opportunities or the scope that is available for youngsters like yourself in terms of pursuing career in a stream like this. So yeah, I think we take that point, and we'll absolutely try to do more sessions like this going forward as well. Next question, can we have access to the recording of the webinar held on the 10th? Yes, I think if I am correct, the version of the webinar held on 10th is currently with our editing team, so it's currently being edited for some bits and pieces, but hopefully it should be out by very early next week. And as soon as that is made available on any public platform, you will all receive an email with you'll all receive an email with heads up that the webinar has been uploaded, so you can absolutely go there and watch it then. The next question is, this type of practical knowledge will be given in an investment banking course. To be very honest, I don't moderate the investment banking course here, but I'd like to think that not many courses available out there kind of gives you a absolutely hands-on and a practical perspective on the markets. So for precisely investment banking course, the content will focus on the aspects that you will need to learn to get an understanding of the operational side of things, right? So more of a middle office and a back office. But on this course, what we are trying to do is we are trying to give you a first full time and a hands-on experience on what happens in the front office. right? And again, these are listed futures, so the processes are more simpler compared to the OTC trades that happen, under a dark pool. I would say that the trades on the OTC are not very transparent. Um, so yeah, I think hopefully that kind of answers your question. So we have 4 minutes, over 7 o'clock. I'm guessing you all must be getting late. So very quickly, let's look at the chart that we promised to come back at, and here you go. So I'm going to turn this back to 5 minutes. At about 7 o'clock, the U.S. cash equities market opened. This was trading at 13,425, and as you can see, there is a decent amount of spike from 425 to 490, which is about $65. So not a huge move really. It appears like a very, I would say, slow day in the US. The opens are slow because even the underlying instruments probably haven't moved as much. Let's very quickly look at it. Yeah, so S&P 500 hasn't moved really, much out of its range of last, I would say, 2 hours range is 47.25 and 25.50, so about 3 points in the course of last 2 hours for S&P. Even at the US cash open, it hasn't moved much. So your spread or the relative value also hasn't spiked massively, but it's starting to move now. As you can see, it's starting to move out of its range in one single direction. And as an intraday trader or a short-term trader, I will stay away from these kind of spikes unless I have a lot of I would say cash, in my account, which I'm happy to gamble for losing or making a killing out of it. But as a trader, I think I'll try to be responsible with all my trades, and only take opportunities when I'm more certain about about the opportunities that market present to me. I'm going to take the last question that I have here is, what is the minimum amount to be invested in this account to trade? The account that we are looking at now is a simulated account. You don't really need any money to get started. But as an individual, again, I think if you wanted access to the global markets, it's a extremely complicated process, and to be frank, individuals are not allowed to trade on the global markets from India, but they can definitely consider opportunities with the firms that trade the global markets. So I think yesterday I gave you an overview on the kind of firms that operate in this space, and they offer opportunities to youngsters like yourself. So you're very free to speak to them after you understand what the job will involve. I'm going to take one last question. I think appears interesting. Is this all process available only to front office in an IB? I am not sure what the I would say intent of that question is. So if at all you can probably try and explain one more time, I'll be happy to answer. How is interactive broker is the other question. I don't want to comment on if they are good or bad, but if you ask me, would I go and open an account with them? Probably not, if I had better options. But again, I think interactive broker is probably one of the brokers that kind of facilitate account opening on the global markets for individuals as well. But again, I would say do your own due diligence on what they can offer you before you decide to go ahead with them. So with that, I think I would like to end this session, and hopefully I probably guessed that this was a bit more technical and short given the content, but the objective was to really give a very high level overview in terms of how is it that the professional traders approach the market. It's not just simply buying or selling one thing or the other and then just hoping for things to happen. It's a more systematic process that is carried out day in and day out, and I think on the floor the life is quite exciting. So hopefully you found it useful. If you think this is the right kind of a learning for you, or if this is something that you would like to pursue as a career, please feel free to get in touch with our counseling team to get an understanding of when we are starting the course. And if you have any questions or any feedback, you can always please send your thoughts or comments on our email, which is corporate relations at imarticus.org. So with that, thank you so much. I hope you had a good time, and I wish you all a very best for whatever you're doing. If you need to get in touch with me, I'm on LinkedIn. My name is Chintan Thakkar, and I hope to be in touch with you, touch with a few of you, in the short time. So with that, thank you so much, and have a great day.
Guys, before we leave, I would like to do one poll. If you would just rate us on how interesting was this webinar, it would be great.
Was I muted for last?
Okay, thank you guys. One more to go. If you would just answer this too. Thank you guys. I hope you had a wonderful webinar session today, and we'll see you soon. Thank you. Enjoy your day.